Hey, everybody. Welcome back to another episode at the Core Integrated Wealth Recording Studios. So glad to have you here. Today, we've got Judy Bode, one of our great portfolio managers, and we're going to talk about, what are we talking about? RMDs and just making sure people are ready for the end of the year?
Yeah.
Okay. So what do you got for us, Judy?
All right. Well, first of all, RMDs are really important that they're taken by the end of the year. Mm-hmm. So a lot of times people have a lot of questions. If they've been taking RMDs for years, they already know what they're doing. They don't often have questions. They just want to make sure they're done before the end of the year. And we always reach out to everyone to make sure they are. But there are a lot of changes that have taken place, obviously.
Mm-hmm. Yeah, the new big, beautiful bill.
Right. And just even in 2020, when they made those changes, that changed a lot with the 10-year rule and everything.
Right.
So I think if we dive into that a little bit, it's going to help people maybe understand some of those nuances.
And just when people think they get it figured out, they change the ages on it, too. And you're going to get into that, too.
Yeah, absolutely.
Right.
Yes, absolutely. So biggest thing is a RMD is a required minimum distribution. It means that when you become a certain age and you have qualified money or money in an IRA, the government basically makes you take out a certain portion of that so that they can put a tax on it, and it's taxable money that you have to take out.
They just want to get their fair share, though, right? I mean, I'm saying that sarcastically, of course.
Right.
Yeah, they want what they haven't had yet.
Right, because it's been pre-tax all these years. So, yeah. So right now the current age is 73. So it was the age prior to 2020 was 70 and a half. Then they moved it to 72. Then they moved it to 73. If anybody turned 72 after 2022, then that age changed. And in a few years, it will change to 75. That age only determines when you start your required minimum distributions.
Right.
So if you've already started them, you have to keep taking them. It doesn't matter what your age is. But and then there are certain accounts that are entitled to, you have to take an RMD from. So those are your traditional IRAs, your SEP IRAs, your simple IRAs, 401ks, 403bs, 457s, any inherited IRAs. Those have a whole set of other rules now than they used to. But those are all qualified money that you have to take money from.
I know it's a lot of clients will come in a little bit confused or concerned. Do I have to take it from my Roth? And they don't, and you're going to get into that too. And I know that's a question we get a lot.
Right. Well, and that's the beauty of a Roth. So people either have Roth IRAs that they have funded, or they have Roth IRAs perhaps that they've converted to from a traditional IRA. Once it's in a Roth, you do not have to take RMDs from it.
Right.
That's after tax money. It's tax deferred, and as long as you have it 5 years and you're over 59 and a half when you take out the earnings, you don't have to pay taxes on that. Also, when we get into inherited IRAs for RMDs, that's a whole nother ballgame.
Right.
So if you it used to be that if you inherited an IRA and you were a non-spouse, you could have stretch that IRA and the required minimum distributions out over your own life expectancy.
Right.
Now, as of these newer changes, you have 10 years to take it out. So you can take it all out the first day, you can take it out over 10 years. It just has to be out of that IRA by the 10th year.
And really, I think you would agree with me on this. It's so unfair to that person inheriting it, because depending on the size of how much that money is, that's a whole lot of tax dollars. And within 10 years to take that out, it really puts that person that inherited that money in a predicament, almost punishes them, honestly.
Yeah, especially because oftentimes they're in their main wage earning years. And so they're already in a higher tax bracket. That's where it didn't used to be so much of a strategy when people took their money out of their required minimum distributions, because it just stretched it out over their own life expectancy. But now they still have to take the RMD every year on their own life expectancy, which does not equate to taking it out over 10 years. But they have to. So there's a strategy involved. I mean, as financial advisors, to really work with them over the 10 years to figure out which years are better for them. Some years they might want to take more out of there to capitalize on the top end of a tax bracket that they're already in without tipping them over to the next one. So there's a lot of strategy that goes on there. The RMDs, of course, this is just for simplification, but it's always based on that 10/31 value of the year before. And then there's a calculation the way it's calculated is they're calculated the end of the year balance, and then it's a life expectancy factor for their age. And that's from the IRS Uniform Lifetime Table. So every year the RMD is usually different because, first of all, the value of your account is different every year. Could go up, could go down. And then your life expectancy is different too. So that calculation is redone every year for those required minimum distributions. Sometimes people have multiple IRAs too.
People we see now with people our age and older, when they come in, because they've got all these assets that are pre-taxed and never been taxed, and they think, hey, we've got X amount to retire on. Well, about 30% of that the government wants their fair share of, and it really puts people in a predicament to say, well, what I thought I had to retire on, I really don't. But I think that's where I know you get into tax loss harvesting, and you get really creative with other things like making donations out of your IRA and strategies like that to help really minimize that.
Yeah, so that changed things a lot too. Back when they changed the taxation, and so many people started just taking the standard deduction instead of itemizing, they lost the ability to gain any advantage over contributions that they were making to 501c3s.
Right.
And so more and more people started doing what's called a qualified charitable distribution, QCD. That's where that money comes directly out of your IRA and goes directly to the 501c3, and then it's non-taxable. So you're still giving, to what's, deep in your heart to give to, but you can give it directly from your IRA, and then it reduces your taxable income because you're going to have to take those required minimum distributions anyway.
Right.
So that's one great thing to do with your RMDs.
And it's got to be a qualified 501c3 to qualify for that, right?
Right. Yep. And there's so many of them out there, And so even if you haven't satisfied your RMD by the end of the year, this is a good time to think, okay, if I don't really need it, if you're thinking about donating to a 501c3, do it before you're, it's end of the year.
It's funny you say that, because I know one of the concerns that clients come in when they get ready to retire, I'm ready to retire, I've saved, I got this much money, the plan looks great, we're ready to go. Their concern is, I can't give and I can't donate as much as I used to now because I don't have my working income coming in anymore. But when you turn on the valve and you say, hey, we can go ahead and take it straight from your IRA, you can still afford to give because you're not getting taxed on this money. It's a whole lot better than taking the money, get taxed on it, then try to give it. Your impact's a lot less financially, but doing it this way, they can have an even greater impact, which is really neat.
Right. Yeah, and especially if you're not itemizing on your taxes, then you're now getting advantage for giving it, from a tax standpoint.
Right.
So yeah, that can be a big help. The RMDs, I should mention too, they're taxed as ordinary income. So when you start taking your required minimum distributions, you get a 1099 at the end of the year, and it's going to show what you took out. Obviously, if you're taking it out as a distribution, you probably want to take some withholding on that and send something to the IRS. We help people calculate that. But then you're going to get a 1099 that you need to file with your taxes for that. The other thing about if you're going to do, going back to the qualified charitable distributions, if you do that, you want to do that before you satisfy your RMD for the year, because that money needs to come out first. Once you've taken your RMD, they want you to do the QCD first. Right. And you also can satisfy an RMD with an in-kind distribution. So if you do an in-kind distribution to a 501c3, that could count towards your RMD as well. So instead of giving cash from your RMD, you can just transfer assets. A lot of times 501c3s have a brokerage attached to them that you can donate that way.
Well, it's interesting, that you said that, because I've seen, you and I have been in the room together with clients, and you brought up that comment before, and people have some highly appreciated stock, and if they were to sell it, they were going to get, like an example, a parent gives them a stock they bought a long time ago before they died. Well, now they've got the parent's cost basis. What they bought for $1 is now worth $200. And if they sell that, they're going to get really hit with taxes pretty hard since they don't have a stepped up cost basis. But I've seen you talk with people and say, why don't you donate that highly appreciated stock? Do you mind sharing a story or how they would do that or where that works out for them?
Yeah, and that wouldn't be so much from an RMD, but that would just be from a non-qualified account. But they could donate that to, again, it has to be a qualified 501c3. But you can donate in-kind assets. So instead of selling them, capturing the taxable gain and then giving the asset, you give the asset as an appreciated asset to the charity.
And it doesn't hurt them on taxes.
Sell it, right, because they're a nonprofit, right? Because they're a 501c3.
It's
so
really
then they
smart,
sell it, right. So you get the benefit of giving to them and blessing them in that way. They get an asset that they can sell. And so that is a big way to help, especially we're at the end of the year and people, people are needy. Inflation is high, and there's still a lot of people in need. So, people like to open their pockets at the end of the year and, feel
philanthropic. Is that how you say that? Yeah, I struggle with that word.
I know. I thought it was going to roll off my tongue, and it didn't. So the qualified charitable distributions, people can do up to $105,000 a year out of your RMD.
Okay.
Or out of your IRA, I should say. You can go beyond your RMD and you can give up to $105,000. And that is for anybody 70 and over. So even if you're not RMD age yet, you can still start to do that. You can still give right out of your IRA to the charity, and then it's non-taxable.
Now, would you... So again, depending on the situation, but when people have a lot of assets that are going to be taxable, and we kind of want to spend that down throughout their life when they're taxed lower, or we want to reduce how much tax liability they have, that maybe it might, depending on the situation, be a decent strategy to say, start doing this now before you really have to take the RMDs. Does that ever come into play?
Yeah, a lot of times people do. Because the other thing is, too, strategy has changed so much with the withdrawal from people's IRAs. It used to be kind of the mindset that you would think, okay, my traditional IRA money is going to be the last money I want to draw from. That's not so much the case anymore, though, because first of all, now so many people are involved in, contributing or converting to Roth IRAs for several different reasons. One of those reasons is it helps your heirs because now they're inheriting money that's not taxable.
Doesn't have a ticking time bomb with 10 years on it.
Right. Of course, you pay the taxes now for them, but if you're in a lower tax bracket, then, and a lot of times people don't convert a whole IRA all at once. They do it over time because you can run into, if you're converting, you could run into raises on your Medicare too. So once you're Medicare age, you're looking at, okay, what are the income levels? Because of course you've got, IRMA's waiting at the door knocking to, the income related adjustment that can cause your Medicare to go up, which then reduces your Social Security check because it comes out of that. So people, there's a lot of strategy involved. I mean, really it's not a one fit all kind of a situation. Everybody's situation is different, and it's a little bit of a puzzle, that you want to put together.
Working on, and a lot of people don't see this. We meet clients, they come in, we meet and we go through their portfolios, we answer questions, but it's a lot of this strategy that's going on in the background that no one ever sees. And actually, I think people are fascinated by it, and until they have to start dealing with Medicare, they really don't think about it because it's off in the future. I don't have to do this yet. But then we have a conversation, and they realize, wow, we're spending 10 or 15 different plates to make it right for them. That's the thing that excites me.
Yeah, I agree. There's a lot of different arrows that are pointing at that plan. So I think one of the other things is that if somebody passes and they're already RMD age, then those RMDs need to continue with whoever inherits. If a spouse inherits their spouse's IRA, they have a choice. They can either put it into an IRA in their own name or combine it with an existing IRA that they have, or they can do an inherited IRA. There are a little bit different rules for that. We usually put it into the spouse's IRA, and then they just continue the RMDs at their own age if they're RMD age. An inherited IRA is the one that would be for a non-spouse beneficiary.
Right.
And then those are the ones that have the 10 years. Of course, a Roth IRA, even though they don't have to take RMDs, they still have to distribute the full IRA, that Roth IRA, within 10 years. They just don't have to take anything out in the meantime as an
Right.
RMD.
Okay.
So, that's a great thing to inherit, though, as a Roth IRA, because if you can afford to keep it there, you can keep that growth tax deferred and then take it out tax free after 10 years. And hopefully you've got a nice, larger asset.
So people, they're not retired yet. They're still working, but they're at RMD age. Whether they want to take it, whether they don't want to take it, but they're still working, there's some significant things to work around in there as well. What would you advise to somebody that they're still working, they're at RMD age? Any advice for someone like that?
Yeah, so if you're still working and you don't own more than 5% of the company, you can delay the RMDs from that company plan. Now, if you have other IRAs, you're going to still have to take the RMDs from that. But if it's your company plan, like a 401k or something, you can keep working, and then once you're retired, you have to start taking those RMDs. But you don't have to take those while you're still working.
So they're 72, 73, 74. They're not required to take them because they're still working.
Right.
Okay.
Right. They can wait to take those, but on any other IRAs, they do have to take those.
Question for you, kind of similar to the topic we're talking with. Let's say they're working, they got 20 more years to work, 10 more years to work. Is it worth having a conversation with someone like you or a financial advisor to say, should I switch my 401k, traditional 401k, over to a Roth 401k? I have 10 more years to work. If someone's in that situation, what would you say?
That question comes up all the time because I think Roth IRAs have become so popular.
Yeah, way more than in the past, especially the last 10 years. It's, it's common stream now.
Absolutely. So more and more people have a Roth option inside of their 401k as well.
And a lot of people don't know it.
And a lot of people don't know it, right? And they don't understand really the difference and how it's going to affect them on a taxation. So, when people... here's what I was going to say before. When we used to tell people save that IRA money, the pre-tax IRA money, to be the last money that you take, because it was assumed that people would be in a lower income tax bracket when they were retired. But that doesn't happen so much anymore because you know what? People have a standard of living and they want to keep that in retirement. They don't, so they're not necessarily in a lower income tax bracket. And so now we tell people, look, if you retire, depending when that is, some people might retire at 60, some people 65, some people 70, all different ages. If take some of the IRA money, now again, this is not a generalization. This is specific to, people.
And their situation.
And their plan.
And they need a conversation with you to come up with the right strategy for them.
Right. But a lot of times people do feel comfortable starting to withdraw from those IRAs as long, you have to be over 59 and a half or else you're going to pay a penalty to draw from your traditional IRA or your Roth. But if they start taking a little bit from there to keep them in the same tax bracket, but they're depleting that IRA, that
tax liability.
The tax liability, because otherwise that just keeps, especially with the market having been so good, it keeps getting bigger and bigger and bigger. Their RMDs are so much more than they need to take later on. And this way, it, number one, kind of reduces your RMD, and it allows, if you have a Roth IRA, it allows you to keep that growing tax deferred, and just start to draw down a little bit of the IRA, especially with the inheritance rules being different now on the non-spouse beneficiaries, so that you're almost giving a gift to your kids of balancing out what you withdraw from your IRA so that you don't leave them primarily IRA money.
Right.
Now, to some people that doesn't matter. To some people it matters a lot. There's a strategy for all of that. But the point is there are a lot more strategies that are needed now than it used to be because it's not all just as simple. So if you really want to maximize your potential in your portfolio, it's like I always say, failure to plan is planning to fail.
Yeah,
so you really want to
absolutely.
get a plan in place the plan can evolve, but you want to have some kind of a plan in place.
Well, and I think another thing too that people don't look at as often, people think, I don't want to lose money in the markets. I don't want my accounts to go down. Well, sometimes that tax loss harvesting can be so valuable because everybody has something in their portfolio. Something's not going to go well somewhere for some company at some point in time. And if you've got to take that RMD anyway, well, shoot, let's take a loss over here to offset that. And sometimes I know that can work out in people's favor too.
Sure. Yeah. The RMDs are taken as, ordinary income. And a lot of times, the capital gains and things that are paid on non-qualified accounts can be capital gain taxes. But definitely, we're always looking at both accounts, both the qualified and the non-qualified accounts, the taxable accounts, because if we can do any tax loss harvesting during the year, we do. And then this is the time of the year when we really look at that to maximize any potential we can for keeping people as tax neutral as possible.
Right. And I think that's one good thing that we do here is like we look at it, like you said, all year long. I know there's other people that say, we worry about it at the end of the year. Well, I know there's been years where the end of the year has gotten really positive and there's no losses to take. So I think it is critical to look at that throughout the whole entire year.
Oh, I think so too. Yeah. Yeah. And right now too, with the, capital gain earnings are just starting to come in on the, being posted of what they're going to be. So if people have mutual funds, especially, the market has been so good and those mutual funds are actively managed. So they've been buying and selling stocks all year long, and that gets passed along to, the owner of the account, which is great in an IRA because all those capital gains that you're getting are in a pre-tax vessel.
Right.
You don't want those as much in a taxable account because they're going to be taxable.
As we're approaching the end of the year, and I know it gets busy for us right now, what would you recommend to people out there that maybe they're not sure if they've taken their RMDs or if they've taken enough? Do you just recommend them reaching out, get a hold of somebody, say, please take a look at this? What would you recommend to them?
Yeah, absolutely. We usually reach out to everybody by the end of the year. A lot of times people have those taken just periodically. So they come out either monthly or quarterly or annually. Some people like to take them at the end of the year because property taxes and
Christmas
holiday gifts, right? But but yeah, if you have any doubt at all about your RMD, always reach out and we'll let you know where you stand on that. I think RMD, I didn't realize until we started talking about it how much different information there is. There are some other nuances as well. You technically on the year that you turn your RMD age, if that age is before April 1st, you can delay that, or if it's after April 1st, you can delay that first year RMD to after April 1st of the next year. But then you end up having to take two RMDs
right.
that
and
year.
And the tax liability is even that much larger.
Right, now you've got two RMDs. So it kind of depends what is the amount of your RMD. So we help people strategize with that as well. But I don't know where the IRS ever came up with those dates, but they've always been confusing to people.
They're extremely creative about how do they get money from us. So they're really good at that. And one thing I think is worth mentioning too, sometimes people say, should I take it all at once or should I take it monthly? Well, number one, it's whatever you want. But if it's from an investment strategy, if you're taking it monthly, well, your accounts are working for you. It's a little bit easier for those accounts, in my opinion, to recoup that as you go along through the year versus if you just take one big chunk out and pay your taxes and now whatever size that money is, it is. However, if they want to take that chunk and reinvest it and get it back in the markets, now it's growing, after tax, then that's a good part of the strategy too.
Right. Yeah, absolutely.
Yeah, it just depends on what people need.
Right. The only other thing I can think of about RMDs is that prior to 2020, if you didn't take your RMD by the end of the year, there was a 50% penalty, and then they reduced that. In 2020, they changed a lot of things, and now it's only a 25% penalty. Any penalty is too much, in my opinion. Right. But it is not as big of a penalty as it used to be if you don't get it taken. But there's really no reason why most people can't get their RMD out, by the end of the year. So. Right.
Well, Judy, thank you very much. This is great. So if anybody has any questions, just call the office at Core Integrated Wealth, ask for Judy, and say, I just want to check on my RMDs, make sure they're taken care of, and we'll get back to them.
Yeah, absolutely.
Okay. Thanks for your time. You bet. Thank you.